Hey folks, welcome to a brand new episode of Smart Money. Now this week, the most popular topic on our social media platforms is what do you do with your money with the markets at a record high? A lot of people are now moving money out of equities and into debt because equities seem to be quite expensive given the level of the market. So today, we have decided to do a master class on how to invest in debt mutual funds. There are so many categories to invest into. There are so many investment avenues. So we have our expert today, Kirtan Shah, the co-founder and CEO of SRE Wealth, joining in now to tell us how you should approach your debt mutual fund investments. Kirtan, good to have you on the show. And this seems to be the most pressing topic at the moment, given that the markets are at life highs and domestic investors are churning. I mean, you can see them selling equities. It makes the case very strong for them to deploy that cash. So amongst other options, debt turns out to be one of the more feasible options to invest in. People feel that it's safe as well. So you tell us, where should they invest? Should you go in for deposits, banks or corporate deposits, or is the most prudent way to invest into debt mutual funds?
Sonia, thank you so much for having me on the show. Sonia, like any other investment, I think you have to consider the merits and the demerits of risk and return before investing into any asset class. And that same goes with debt as well. My only problem is that while I interact with the retail investors, I feel that most of us ignore the risks that are associated with that. Is because what happens is while all of us are investing in deposits, we know that we are going to get a fixed return over a period of time, and that makes sure that a lot of us ignore the risks associated with the investment. And that is exactly what I would like to highlight here. Look, investing in deposits are not risk-free. For most retail investors, risk is only losing of capital, but that is not the only risk that you look at. Let me highlight three most important ones, in my opinion, while you are looking at investing in deposits. So while I talk to a lot of retail, I understand that before they get a professional help, most of us invest all the corpus that we have in 2 or 3 deposits. Now, what ends up happening is while you deploy the entire 100 rupees that you have in, let's say, 3 deposits, you end up taking a lot of concentration risk. And tomorrow is something like a Yes Bank perpetual bond or a Lakshmi Vilas Bank tier 2 bond or even a DHFL or an ILNFS kind of a case happens. Most investors end up losing 1/3 of their total investment. I think that's a big risk while we are investing in deposits, which is concentration. Second, very importantly, is that most of us invest to beat inflation. Now today, if you look at the current rates that let's say an SBI bank fixed deposit is offering is close to 5%. Now if you are in the 30% tax bracket, what you get in hand is 3.5 after tax, which is half of what the inflation is. So we are not beating inflation, which is another problem that I have with most of these deposits. And third, which is another important one that we tend to ignore, is the illiquidity risk. So today I might invest for 3 years because I feel that I have 3 years at hand today. But tomorrow, due to any emergency, I might want to withdraw some money, let's say at the end of the first year. But banks or any other deposit does not allow me to do that without an interest penalty to me on that. Now, these are various risks that, apart from a lot of others that I can talk about, that we don't consider while we do deposits. And hence, in my opinion, I think mutual funds are a better option to do over deposits, Sonia.
You know, Kirtan, I'm so glad you brought this up because everyone who invests in fixed deposits, corporate deposits, believe that it is risk-free, right? And you spoke about the top 3 risks: concentration risk, illiquidity risk, as well as the fact that you're just not beating inflation with so many of these deposits. So now that this is out of the way, you said the most prudent way to approach debt is through mutual funds. We'll talk about which are the best mutual funds to invest into. But before that, how do debt mutual funds manage the above risks that you spoke about?
So Sonia, let's take each of these points one by one. So while I spoke about concentration risk being one risk in deposits, let's say while you invest 100 rupees in a debt mutual fund, the debt mutual fund would then invest that into 50 or 100 different bonds in the market. That's how the concentration risk by investing in just one scheme of a mutual fund is got down so much versus the example that I gave you for a deposit. So say for example, after having invested in a mutual fund, even if one of those bonds in which the mutual funds have invested defaults, the impact on the overall investment is much lower. That's point one. While we also spoke about illiquidity, in a mutual fund, you can remove your investments and get the redemption in as good as T+1 day. Of course, there are some products where there is a 7-day or a 1-month kind of an exit period, but that's way too low from what deposits offer. And third, while we talk on taxation, Sonia, there is an indexation advantage that you get while you invest in mutual funds. So let's say if you've stayed invested in debt mutual funds for more than 3 years, then your tax is much lower. To give you an example, let's say a debt mutual fund generates 6% and the inflation over the same 3-year period has been 4%. So what you've netted as return is only 2%. The way taxation works is you only have to pay 20% on this 2%, which is 0.4. So even if you are in the 30% tax bracket, all you end up paying is 0.4 on 6% that you've generated. That's how you make a 5.6% net tax, post-tax return in a debt MF versus a similar comparison of 4.2 in deposits. And that's how it solves the problem, in my opinion, Sonia.
Okay, so just one follow-up there. You're saying that from a taxation angle, it's better to invest in debt mutual funds compared to deposits, fixed deposits. But from a taxation angle, equity is more lucrative, right?
Absolutely, Sonia, any day. Look, at the end of the day, these are two different asset classes meant for two different purposes, right? So broadly, I would still recommend that everybody follows a proper asset allocation strategy depending on the risk profile that they come with. But while we talk about debt, I think this is the best option versus the other debt options available.
Okay, I got that. I just want that clarification. So, I mean, for those of you who have a chunk of your money in fixed deposits and corporate deposits, it would be better off if you want to stay in debt to invest in debt mutual funds. But here is where the problem begins, right? Because there are 15, 16 different categories within debt mutual funds itself, and some of it is very complicated. I mean, there are these complicated terms: ultra short duration, long duration, medium duration, overnight funds. So, if you just had to give us a masterclass on these different categories and where should I invest, what would your answer be? I know we will have to go into an hour-long interview, but just to summarize it for us.
So, Sonia, to answer your first question first, look, like you rightly pointed out, there are 16 different categories. So, if as an investor you understand how are these categories different from each other, to a greater extent your problem will be solved. So, SEBI divided all of these funds basis 3 major data points. So, the first data point is the average maturity, which means that while you invest in a mutual fund, how longer maturity paper can this mutual fund invest in? So, if you look at something called as an overnight fund, if you look at something called as a liquid fund, or you look at something called as a money market fund, these are the 3 funds who are following this guideline of SEBI, where if I invest in an overnight fund, my average maturity will not be more than 1 day. If I invest in a liquid fund, my weighted average maturity will not be more than 91 days. And similarly, if I invest in a money market fund, the average maturity will not be more than 1 year. That's one category. The second category is duration, right? So a lot of these funds that you spoke of, which is the ultra short term, low duration, short term, medium term, and so on and so forth, they are categorized basis Macauley's duration, right, by SEBI. And the third category, basis which these 16 funds are divided, is the credit rating. So there are some funds like a corporate bond fund or a banking PSU bond fund or a credit risk fund in which SEBI tells you that this is the category of debt that you should invest in. For example, if you are investing in a corporate debt fund, the fund has to compulsorily invest close to 80% of its money in close to AAA rated papers. So that is how these 16 categories are bifurcated basis these 3 things that we spoke of, which is average maturity, duration, and credit ratings.
Okay, Sonia. I do want to talk a little more about the risks because, we've seen a lot of these issues blow up in the past, right? Where bonds, these papers just go into junk category and retail investors are left with losing all of their money. So just tell us, what are the risks that investors should keep in mind before investing in debt mutual funds?
So Sonia, 2 very important risks that everybody who's a debt investor should keep in mind. First is the credit risk. What is credit risk? Like you've rightly identified, that when I invest money in a debt mutual fund and when that mutual fund is investing in 50 or 100 more bonds, one of them might default, right? Now, how do I understand whether how much or how less is the credit risk in the portfolio? You look at something called as credit rating. So each of these bonds in which the fund invests will all have a credit rating. So if you see a credit rating called SOV, which is sovereign, you have to understand this is a government paper and the risk is very little. And then while you talk about corporate papers, you will have credit ratings like AAA and AA. Now AAA, AA are considered to be decent ratings, and similarly on the money market side, you will have credit rating called A1+. So in my opinion, if you see sovereign, AAA, AA or A1+, this is the best portfolio with the lowest credit risk possible, right? Anything below this or anything that you see outside of this might carry slightly more credit risk. So that's point one. The second risk that you should look at, Sonia, in my opinion, is interest rate risk. Now, what is interest rate risk in very simple terms? Let's say you invest in an SBI bank fixed deposit today, which pays you 5%. And after having invested today for 3 years, if interest rates in the market go up, you still keep receiving this 6% which you've locked yourself in at. Which is why whenever interest rate goes up in the market, the bond that you bought or the fixed deposit that you bought at a lower rate falls in value. Now this is interest rate risk, which in simple terms will be, if interest rates go up, the value of your bonds will fall, and if interest rates go down, value of your bonds will go up. So these are two risks to keep in mind while investing in debt, Sonia.
Okay, that's really very important, and I'm glad you clarified a lot of that jargon for us as well. What I'm going to do is I'm going to take a quick commercial break, because at the end of the day, we want to know what are the debt mutual funds to invest into, right? So don't go anywhere. We'll come back in just a bit on Smart Money. We're back with you on Smart Money and CNBC TV 18. Well, today we're talking about the A to Z of debt mutual fund investing. Now, equities has always been the more exciting investment avenue, and debt is sort of boring. But we're going to spice it up by telling you what are the debt mutual funds to invest into, what are the risks associated as well. Keertan Shah is my guest. Keertan, before the break, you were talking about the risks involved while investing in debt mutual funds, and also how debt mutual funds are a much, much better opportunity than pure fixed deposits or corporate deposits, right? So how does one decide on investing in debt mutual funds, and what are the top 5 debt mutual funds that you would advise investing into this year?
So Sonia, again, I'm going to go back to the two risks that we spoke of. First is credit risk and second is interest rate risk. Now, in my opinion, look, credit risk has to be very dependent on your risk profile and your asset allocation. What do I mean? Suppose if you are a conservative investor who does not want to take a lot of risk, then you make sure that you invest in schemes where most of the money is invested in papers which either have a sovereign SOV rating or a AAA, AA or an A1+ kind of rating. That will make sure that the credit risk in the portfolio comes down significantly, which is something that you don't want to take as a conservative investor. Now, the second risk, which is the interest rate risk, is slightly technical in nature. Now, what do I mean? Let's say if you are in a situation where interest rates you feel have bottomed out and are not going to go any lower than this, then you invest in schemes which have low duration or low modified duration. What it means is modified duration is nothing but a sensitivity to interest rate change. What do I mean? If I expect that interest rates are not going to fall more than here, which means interest rates are supposed to go up, we've understood if interest rate goes up, debt falls in value. Now I want my debt to fall very less, which is why I will invest in schemes which have less duration, by which I will make sure that the schemes are falling less. This is given in the fact sheet, and you don't have to hunt outside anywhere to figure out what is the duration, high or low. Similarly, if I feel that interest rates have topped out and interest rates are not going to move up from here, which means interest rates will go down, and I know if interest rates will go down, debt will go up in value. So I would want to invest in high duration funds. So in short, broadly, you'll decide whether you want to take credit risk or not. And after you've decided whether you want to or not, you decide on funds which have higher or lower credit risk. And depending on the interest rate cycle in the market, you decide which amongst these funds do you want to invest in. To keep it very simple, if you look at the last 10 years history, 10-year interest rates have moved between 6% and 9%. So whenever you are close to 6% on the 10-year GSEC, you would want to invest in low duration funds. And when you are close to 9% on the 10-year GSEC, you would want to invest in high duration funds, Sonia. And because I expect that interest rates have bottomed out.
That was my next question actually. So if you feel that interest rates have bottomed out and this is the best time to perhaps invest into low duration funds, how do you decide which one? And can you give us some names? Because at the end of the day, that's what our viewers would want to know, right? Which are the debt mutual funds that still look attractive now?
So Sonia, of course, yes, I expect that interest rates have bottomed out and probably they'll stay flat or start moving up over a period of time. The easiest way to figure out which investment should you pick is looking at something called as average maturity in the fact sheet. So it is written on the fact sheet. Now, what is average maturity? Let's say if you go to the bank and you want to invest for 1 year, you don't do a 6 months fixed deposit or a 2-year fixed deposit. You do a 1-year fixed deposit, right? So that is what average maturity in a debt fund is. It tells you that this is for how much time you should stay invested. So what do I mean? Let's say if you want to invest for less than 1 month, right? Then you should opt for these funds called overnight funds because their average maturity is less than 1 year. If you want to invest for anywhere between 1 to 3 months, you should look at investing in something called as liquid funds because their average maturity is anywhere between 1 to 3 years. And similarly, if you want to invest for 3 to 6 months, you look at ultra short term. If you want to invest between 6 to 12 months, you look at low duration or money market funds. And if you want to invest between 1 year to 3 years, I think you should look at short-term debt funds, corporate bond funds, and banking PSU. And in my opinion, this is the bandwidth or categories in which you should currently stay invested.
Okay, so you've told us about the bandwidth and the categories. We are getting a lot of queries. So I just want to read out a couple of them to you and toss the question to you as well. Prem has written to us saying, how does one really decide how much should you invest at the start, lump sum or any advantages in investing in tranches? How should you be splitting capital among several durations like short, long, etc.? And he's also thanks us for this show. So if you want to leave our viewers with some advice on how does one really do asset allocation in debt mutual funds, what would your advice be?
So Sonia, look, like we know, there is somebody who's conservative, there is somebody who's moderate, and then there is somebody who's aggressive. Let me take a case of a conservative investor right now. The biggest problem that I see here is, as a conservative investor, when you have 100 rupees, you would want to do 80% of that in debt. But typically, most investors end up investing that 80% into 1 or 2 funds, which is something that I would advise against. So what you ideally do is this 80% that you have to invest in debt, you split that into 3 buckets. The first is the liquidity bucket, in which 10% of your debt investment should be parked in overnight or liquid funds. Then you have something called as your core bucket, where 70% of your debt investment should get allocated. Now, if you are a conservative investor, I'm believing you don't want to take a lot of risk, and hence you should look at doing something called as ultra short term, low duration or money market funds. And the remaining 20% that you have is where you can do a tactical allocation to generate slight alpha without really increasing your risk, is where you can invest in short-term debt fund. So that's how the 80% money that you want to allocate to debt is further invested 10% in liquidity portfolio, 70% in core portfolio, and 20% in tactical portfolio. That is what I would advise investors to do, Sonia.
Okay, so that's very interesting. You can see what a if we can just get that screen back up for you, what a conservative investor should do. 80% of your asset allocation should be in debt, 20% in equity. But does this hold true also for a young investor? I mean, I'm not talking about the investment philosophy, but if someone is just starting his career, this show is for a lot of people who've just entered the market, a lot of the Gen Z, as they call it, millennials. This would not be the right asset allocation for them, right? I mean, they should top up more on equity, right?
Absolutely, Sonia. I think all of us who've been in the markets have seen how markets have always performed, and over a period of time, the compounded annual growth rate that the market ends up offering is much higher than most of these other investments. So definitely somebody who's young, somebody who's just started their career, I would sincerely advise them to look at allocating a larger portion to equities, not lump sum, but through an SIP, where over a period of time their risk is, kind of averaged out. And the more the time you would give to your investments, I think the more the investment will really be able to create wealth over a period of time and help the investor achieve goals, which are largely the reason most investors would want to invest.
Okay, so that's some holistic, advice coming through on both investment in debt and equity and what the asset allocation should be. Finally, we're getting a last query coming in asking us, can you discuss the list of top 5 debt mutual funds, the reasons for the same, so that it becomes easier for one in deciding while selecting the debt mutual fund? What would your answer be?
So Sonia, because I am expecting that rates have bottomed out and probably they'll stay flat or start moving up, I will not want to take duration risk, and hence my 5 advice to stay invested would be on the lower end of the duration. So I would invest in ultra short term, low duration and floating rate bonds, bond funds. So I would invest in SBI ultra short, Aditya Birla low duration fund, Axis Treasury Advantage fund, and I will invest in 2 floating rate funds, which is ICICI and HDFC. Because look, floating rate fund is a fund in which when interest rate moves up, automatically the rate that the bonds pay the mutual fund also keeps adjusting higher. So I think if interest rates are going to go up, then the interest rates in which the funds have invested will also keep moving up, and hence floating rate funds make a good case in my opinion right now. So these are the 5 funds that I would advise investors to stay invested in, Sonia.
Well, Keetan, it was really a pleasure speaking with you, and personally, I learned so much about the debt space. I mean, being in this market for over a decade, I also didn't have so much clarity as much as I have now after listening to you, talk about debt mutual funds, the risks involved, and, the difference between investing in debt mutual funds and in fixed deposits. So thanks a lot for joining us. I hope you guys enjoyed this masterclass on debt mutual funds, and keep writing into us, give us your feedback, and we'll be back next week, same time, same place. With that, it's a wrap on this CNBC TV 18 special. Thanks for watching.